In Chapter 12, we are looking at nature and recording of current liabilities. We are looking at accounting for note payable, which is note payable might be current liabilities, might be long-term liabilities. Contingent liabilities, we're gonna look at those and also look at the payroll and payroll related taxes. If you don't take the payroll class with me, then this will be your only payroll chapter that you're gonna learn something about payroll. Let's go. So in regards to current liabilities, what is current liabilities? Those are liabilities that needs to be paid within the next 12 months or operating cycle, whichever might be longer. In most cases, operating cycle for a business is 1 year or less, but in some businesses might be a little bit longer. So operating cycle is the cycle that you spend money, finish the job, send an invoice to your client, collect the cash, and then deposit the cash. That cycle of spending money, generating goods and services, and then collecting cash again, that's an operating cycle. So current liabilities that needs to be paid within a year or less in general. And here it explains the operating cycle again. Normal typical current liabilities are accounts payable. Those are amounts due to suppliers relating to the purchase of goods or services on credit. Obviously, you might sometimes pay for expenses cash right away. That's fine by writing a check, but normally you get an invoice from your vendor and then you are going to pay those down the road, and that will become an accounts payable for the company. Note payable is a form of short-term borrowings, usually evidenced by a specific written promise to pay, including interest. So the difference between note payable and accounts payable is accounts payable, you never pay interest, you just pay the whatever you owe. But on note payable, not only you pay the principal, but also you need to pay interest. Note payable might be just short term, like 3 months note, or might be long term, like 30 months, 3 years, 30 years, 10 years, 5 years, depends. So it might be longer or shorter. But whatever is note payable, the portion that you need to pay within the next 12 months needs to be recognized in your balance sheet as a current portion of long-term liabilities. In the current liabilities section. Okay. And let's see if I have an example here. Yes. The current portion of long-term debt is another frequently encountered current obligation. So you have to recognize that as current liabilities. When a note or other instrument, debt instrument, is of long duration, let's say 3 years or whatever, it is reported as a long-term liability. However, the amount of the principal, which is to be paid within 1 year, or the operating cycle, whichever is longer, should be separated and classified as current liabilities. For example, we have $100,000 long-term note, maybe paid in equal annual increments of $10,000, let's say. So every year you need to pay $10,000. So plus the accrued interest. At the end of any given year, the $10,000 principal due during the following year should be reported as a current liability, along with accrued interest, with the remaining balance shown as long-term liabilities. So any accrued interest plus the portion of the principal that needs to be paid within the next year has to be in the current section of liabilities. The remaining $90,000, let's say in this scenario, in this example, the remaining $90,000 will be shown in the long-term liability section of balance sheet. Accrued liabilities are liabilities that needs to be paid because it's already accrued and the obligation of payment is established. So the company has to pay them within the next, let's say, 12 months. Like wage expense, like tax expense, interest expense, or anything like that. Okay, so let's see. And you know what unearned revenue is, right? Unearned revenue is a prepaid cash by customers for future services. And that needs to be recognized also as current liabilities. We learned those, but we just, explain those one more time here. So collection of third parties, dollar amount, if you collect anything for the third party, that is also a liability. For example, you collect sales tax from customers. So sales tax, it's a collection of third parties, collection for the third parties. And when you collect sales tax from your customers, that sales tax by end of the month needs to be paid to the government. And that's current liabilities also. What is this? Let's read this one. Obligations to be refinanced deserve special consideration. Long-term debt may have an upcoming maturity date within the next year. Okay, if anything is within the next year, then needs to be recognized as current liabilities. Ordinarily, this note would be moved to current liability section because it needs to be paid within the next year. Even though originally it was long-term liability, but now it's to the point that whatever is left is gonna be paid and finalized within the next year, so it has to go to current liability. So it will move completely out of long-term liability and goes to current liability section of your balance sheet. All right, let's read this one. So a currently maturing long-term obligation is to be shown as current liability unless, number one, the company intends to renew the debt on a long-term basis. So they're going to refinance it again as a long-term. Two, the company has the ability to do so, ordinarily evidenced by a firm agreement with the competent lender. So two things needs to be satisfied. If you have a current liability long-term liability that is going to be matured within next 12 months, and still you don't want to show that in current liability, two things needs to be satisfied. And if you are a publicly traded company, the auditor wants to see that. Auditor says, okay, this is the long-term liability that needs to be, the maturity date is within next 12 months. Why you don't move this to current liability section? You say, first, my intention in this company, our intention is to refinance this liability again to another, let's say, 5 years loan or something. And then the second part is, and here is a letter from company or from a bank, from a lender that is going to finance this liability for us by, let's say, 10% annual interest rate for another 5 years or 10 years. So you should have also a letter to prove that ability of the company that they can refinance this loan for another longer term. So far, so good. So let's see what is note payable. Note payable is a promissory note. It looks something like this. It says, okay, this is for value received, the undersigned promises to pay to the order of Bank Zone Incorporated the sum of, let's say, $10,000, along with annual interest rate of 8%. So not only 10,000, but also 8% annual interest rate. This note shall mature and be payable along with accrued interest on June 30th of 2000, let's say, 18. And this is January of 2018 that is the issue date. And it is like probably like 6 months later, that is the maturity date. So this is a 6 month promissory note. The journal entry for the promissory note is recording of borrowing of $10,000 for the company and recognition of liability for this note payable. And because it's 6 months note, then it means this is a current liability. And this is the maturity time, because between those two dates, there is no there is no end of the period financial statements. So they can just wait all the way till 6 months later. And 6 months later, because it's between the periods still, so they can easily recognize the interest expense at the end of 6 months by debiting $400, which is $10,000 here, $10,000 times 8% times 6 months out of 12 months, and that gives us $400. So interest expense will be recognized for $400. Note payable will be closed, which is a debit, and cash will be credited to write a check for $10,400 to pay this liability. And this can be done this way because there is nothing in between of these 6 months where we prepare financial statements. However, let's say we borrow this on October. And in that case, we record the borrowing of $10,000 in October. However, 3 months later, in December 31st, we record the accrued interest of $200, and the interest payable liability, current liability of $200. We record this because it's end of the period. We are going to prepare financial statements, and anything happens in this period needs to be recognized in this period of time. So far, so good. And this is how you do it. 10,000 times 8% times 3 months out of 12. However, 3 months forward in end of March of 2019, let's say, in that case, we have another 3 months of interest to record for January, February, and March. We have the 3 months interest liability to close, which is debit. We need to close the note payable, which is also debit, and write a check for $10,400. So make sure you're perfectly capable of recognizing this type of borrowing, end of the period interest recognition, and maturity date payment journal entry. Okay, if we are okay with this, let's move on to, let's look at the balance sheet. Looks like this is a balance sheet. We have current liability section of the balance sheet. In a balance sheet, in the liability section, you have two parts, either current liabilities or long-term liabilities. So current liabilities might be accounts payable, salaries payable, tax payable, unearned revenue, which is customer prepayments, same thing, unearned revenue, interest payable, or also current portion of current liabilities in regards to note borrowing. So here, as you see here, at the end of the December 31st, because 3 months of borrowing happened, so we recognize the $200 note payable, also $10,000, $200 interest payable, and $10,000 note payable. And this is from this journal entry. Now you see we have an interest payable here, and from this journal entry, we have a note payable in here. So in the December 31st, we need to recognize those two liabilities as current liabilities. And why is so important to recognize something as a current liability? Because that will change the ratio in regards to liquidity of the company. And changing ratios of liquidity of a company will have a big effect in future borrowing and interest rate that this type of company might receive in regards to borrowing from somewhere else. Or even investors, they like to know, investors want to know what's the current liquidity ratio for this company. And if this company is capable of paying the current liabilities with its current asset and stay alive for another year at least. And that's a liquidity ratio. Here is showing you also another way to calculate the interest. Let's say if the interest is based on days instead of months. So you can say, okay, principal times annual interest rate, let's say 8%, times 180 days out of 365 days. In some cases, you might see 360, like this one, which is the same thing, that doesn't matter. 360 is much round number, and it's easy for accountants to calculate that way. So either divide by 360 or divide by 365 is fine. Okay, okay, we have to read this one. On one last item to note that in some cases, the lender might ask for an interest upfront. The note may be issued with interest included in the face value. For example, $9,000 may be borrowed, but a $10,000 note is established. That means interest is not separately stated. At maturity, $10,000 is repaid, representing a $9,000 repayment of the original borrowing plus $1,000 interest. Note that the interest rate may appear to be 10% or something like that, $1,000 out of 10,000, but the effective rate is much higher, obviously, because 1,000 for 9,000 is 1,000 out of 9,000 is 11.11%, not 10%. So you might look like, say, oh, this is 10% interest, but if you calculate it properly, $1,000 interest for $9,000 borrowing, that ends up to be 11.11%. The journal entry to record a note with interest included in the face value, also known as a note issued at discount, is as follows. So this is how you record the cash. you record $1,000 discount on note payable, and here is note payable. Just look at this carefully because later on we will have a look at bonds, and in the bonds will be also very similar, but instead of saying note payable, we will say bonds payable. So here they call it bonds payable and discount on bonds payable instead of discount on note payable. So this is how you journalize it at this moment. So cash is debit, discount on notes payable, because it's not accrued yet, will be recorded as a debit. You cannot call this interest expense at the beginning, okay? Because it didn't accrue yet. You have to wait. You have to wait till every month pass by, and then that will be recorded as interest expense. At this point, you just record it as discount on note payable. Okay, let's say this was on January, right? If this was let's say a year later, at the end of the year, this was January 1st, but at the end of the year, let's say December 31st, if you have, because you have to pay, right? You have to pay the note after 1 year, right? Let's say this is a 1 year note. And also you have to pay the interest. But the interest is already deducted in here, right? And we recorded as discount on note payable. So on December 31st, we close that discount, okay? And we record interest expense. The reason you can wait 12 months to do this, again, why you can wait 12 months to do this journal entry, because in between of these 12 months, let's say you are not preparing financial statements. But if you do prepare financial statements in between, then you have to amortize this discount on note payable ahead of time on a monthly basis or quarterly basis. But if there is no financial statements necessary to be prepared within the next 12 months, that's fine. You can wait until end of the year when the maturity comes. And at the maturity time, you just close the discount on note payable and record interest expense for the last 12 months. And also you write a check and you pay $10,000 to close the note payable. Make sense? Okay. Okay, what is contingent liability? It's an event that may or may not give rise to an actual liability because the outcome is uncertain. Examples include lawsuits, environmental damage, or something like that. So it's a contingent liability. In order to record a contingent liability, depends what the situation is. If it is probable, okay, and subject to reasonable estimation, that means it is probable and estimable. If it's probable and subject to reasonable estimation of the total liability. If those two scenarios are checked out, then you have to record the contingent liability in the financial statements. You have to do journal entry for that. However, if it is just reasonably possible, okay, if it's reasonably possible, then you just need to put a footnote and you have to disclose it in the financial 10K, in the annual report. You have just to disclose it. However, if the possibility of that contingent liability is remote, then you don't need to record anything. You don't need to disclose anything. Let's look at a warranty, let's say. Warranty expense is something that most companies have for their products. And they normally can, roughly estimate how much warranty liability they might have for every year of sales. So let's say this company in this year sells about $3.5 million of product. Very good. So they sold something. But at the end of the year, they need to estimate that how much of these sales might end up, into a warranty expense because they have to fix something and buy parts and, fix it and return it to customers. So those type of warranties needs to be estimated. And based on, let's say, experience, like this company thinks about 2% of sales normally ends up in the warranty expense. So 2% of $3.5 million sales is like $70,000 warranty expense. But because nothing happened yet, so they record it as liability, which is warranty liability. Let's say a few months down the road, in the middle of summer, some of those products will come back, and the company needs to spend money to fix those like not properly functioning products. So at that case, the company will spend some cash to pay for labor or material or whatever to take care of those warranty liabilities, and that will end up to be reduced from the warranty liability account. So this is also a adjusting entry. Remember, in this course, we learned that at the end of the year, there are a lot of adjusting entries, accrual entries or deferral entries. So this is an accrual entries because something might accrue. So here's something we recognize that might happen in future, and here, if it happens some way, somehow, we deduct it from the already recognized liability of $70,000. So here, as you see, the liability was recognized for $70,000, but the accrued liability, the actual liability was more than that, $80,000. So it looks like we didn't recognize enough liability in this year. And because of that, let's say the warranty liability at the beginning from last year had $25,000 in it. This year, we recognize 2% of sales might be a warranty liability. So that's 25 plus 70 is like 95. And we spent $80,000 for fixing things for the warranty. So we end up with $15,000 ending balance on warranty liability. And we move this balance to the next year again, and we recognize maybe another 2% or 2.1%, whatever you believe it's proper, and see how it goes. But if the warranty liability ends up on the credit side, definitely next year you have to change your percentage. Are we good? Okay. Okay. The last part of this book, this chapter, is about payroll, which is very important subject in any business. And if you like, take the class down the road in fall or spring. But for now, if you have some people doing independent doing some work for you as an independent contractor, then you have to give them a 1099. The reason they are independent contractor because they decide how to do the job, when to do the job. All it's important is just finish the job the way they promised. So they are not your employees. You cannot control them. You don't order them. You don't tell them what time to show up, when to take a break or whatever. They work independently. However, employees are under control of the company. So company tells them what to do, when to do, when is the break time, and all those details. So that's employee. So that's the difference. So 1099, Form 1099 will be given to an independent contractor at the end of the year. However, regular employees, they get, it's not in here, but employees, they get W-2, Form W-2 at the end of the year from company. In the Form W-2 shows that the total compensation was whatever, and minus federal income tax, state income tax, Social Security tax, Medicare tax. All those stuff will be detailed in the W-2, and then Form W-2 will be used in the tax return for the employees by themselves when they prepare taxes. And you give 1099, normally 1099 doesn't have a specific tax deduction on it. It's just the gross amount of the pay. And then that 1099 will be used by the independent contractor in his individual tax return, and he will show in the Schedule C that he got this much from this company, and based on that, he has also some expenses, whatever might be, and therefore he has this much income, and based on income, he will pay the income tax. Any questions so far? You're good on this? Okay. And normally employees, they have gross pay, which also known as gross earning. It is the total amount earned by an employee before any deduction. But after deductions for Social Security, Medicare, and income tax, like federal income tax, state income tax, then they end up by having a net pay, which is also known as net earning. This is the gross pay less all applicable deductions. And income tax is normally deducted from the paycheck for the federal government and for the state government. But how much will be deducted? That depends. Employees give the employer at the time of hiring a form called Form W-4, which is a form filled out by an employee stating the amount of exemptions to which they are entitled for the tax purposes. Such exemptions bear on the amount of income tax withholding. That means you tell in the Form W-4 that you are single, you are married, and how many dependents you have. And based on that, if you are married with 5 dependents, the withholding of income tax will be less. But if you are single with no dependent, then withholding on the income tax will be much higher from your paycheck. And the information in W-4 will be used in the payroll software to calculate what amount of tax needs to be withheld. So Social Security and Medicare taxes are also known as FICA. And what FICA means is Federal Insurance Contribution Act, which covers Social Security and Medicare. This Social Security and Medicare must be withheld by employers, and up to age like 67 at retirement time. And after retirement, the taxpayer will get a Social Security payments as a form of, compensation for retirement, and also get Medicare health insurance coverage. Okay, but how much is FICA or for Social Security and Medicare? Here says assume 6.5% for Social Security tax, but I tell you exactly how much it is. You don't need to assume anything. So the actual Social Security tax is 12.4%, and 12.4% divided by 2 will be 6.2% employees' responsibility to pay. The other 6.2% will be paid by employer. However, if you are an independent contractor, the company pays you a check for your job, goods or services you provided, and it will not deduct anything. But then who's going to pay for Social Security? 12.4% completely will be paid by independent contractor when he files his own taxes. So an independent contractor will pay complete 12.4% for Social Security. But if you are an employee, then half of it will be paid by employee, which is 6.2%. The other 6.2% will be paid by employer. So far, so good. And so Medicare. Medicare is 2.9%. 2.9 here again says assume 1.5%, but you don't need to assume. I tell you exactly how much it is. So Medicare is 2.9%, which if you are employee, you pay half of it, which is 1.45%. So 1.45% of gross income will be paid by employee, and 1.45% of gross income will be paid by employer. However, if someone is independent contractor, then independent contractor is responsible for the complete 2.9% of Medicare tax. So what it means is this: if you are independent contractor and you made, let's say, $1,000 from, let's say, delivering, some food for Uber Eat, or let's say whatever. So you are an independent contractor and you make $1,000. Out of that $1,000, you need to understand that you need to pay 12.4% plus 2.9%. So what is 12.4 of 1,000? 12.4 plus 2.9. That is 15.3%. Do I have a calculator here? Yes. Here. So 12.9 for Social Security plus 2.9 for Medicare. That's 15 point. No, something is wrong. Let's see. 12.4 plus 2.9. 15.3%. So 15.3% of $1,000, that's $153. So if you make $1,000 as an independent contractor, you need to understand that $153 is just Social Security and Medicare that you need to pay at the end of the year. So you better to, pay estimate taxes to IRS if you are an independent contractor on a quarterly basis. So by end of the year, you have already submitted enough estimated taxes to the IRS because you are an independent contractor. But if you are an employee, you don't pay 15.3% of your $1,000 income. You pay only 15.3 divided by 2, you pay only 7.65% for Social Security and Medicare. The other 7.65% will be paid by employer. At the top of that, there is also payment that needs to be withheld from employee's check, which is federal income tax and state income tax. And in some cases, also a portion of the health insurance that needs to be paid from employee's pocket. And if also employee wants to contribute to 401k retirement account, then that is also needs to be withheld from employee's paycheck. So here we have, let's say, $1,819, $1,819 net paycheck. That's okay, but where is that $1,819 coming? $3,000 is the gross pay, which is have some deductions. Federal income tax, it is based on W-4. If the employee is married, how many dependents they have, this dollar amount might be a little bit more or less. Same thing is in state income tax. So I don't know how much they might technically be. But Social Security tax is easy because that's 6.2% of that 3,000. Medicare is 2.9% of this 3,000. No, sorry, not 2.9. 2.9 divided by 2, which is 1.45%. 1.45% of this $3,000, and let's see. Insurance. This is health insurance, employee obligation or employee part of the obligation of health insurance. Also, an employee wants to put $200 in retirement saving account for 1K. That's fine. Also, that will be also withheld. Employee decided to pay every paycheck $25 to a charity or something. That's good. And also, employee wants to contribute to health childcare plan that the company is offering and probably contributing to. So here, the employee pays $75 and probably there's a match about for this from the company side. So these three things here, as you see, it might be matched by the employer to some degree. Let's say charity, maybe employee doesn't match anything, but retirement, let's say the company says dollar to dollar, I will match. And let's say childcare plan also maybe dollar to dollar, they will match. Bottom line, this will be withheld from the employee's paycheck. And all of a sudden, the employee is taking a check home, net pay of $1,819. Okay, those things that has been withheld from the paycheck, those are not something that belongs to business. That belongs to current liabilities because the company is withholding this for the third party. So here, there's $3,000 salaries expense that cost to the company. However, company is going to create current liabilities for federal income tax payable, state income tax payable, Social Security tax payable, Medicare tax payable, insurance payable, retirement contribution payable, charitable contribution payable, and health child plan payable. And end of the day, just write a check for $1,819. Any question possibly? Anyone? Don't be shy, okay? Ask questions, please. Looks like it's easy, so let's move on. So we got the idea of what is deducted from employer. But this is not the end of the story. Remember, the employee, this is deducted from employee, but employer also needs to match. Employer needs to match here, Social Security and Medicare. and put the rest of the insurance payable, also health insurance. Possibly sometimes they match with retirement contribution also. So one more thing that employer needs to pay, which has nothing to do with employee, is just absolutely employer responsibility. It is Futa and SUTA. SUTA is state unemployment tax, which some states, they have such a thing, like California has EDD. And Futa is federal unemployment tax, which is paid directly to the federal government. If there is no state government for unemployment tax, then every single penny goes to Futa. However, if, let's say in California, we have EDD collecting SUTA, then Futa just gets, in general, gets only 0. Let's say out of 6.2%, gets only 0.8%. Sometimes it is 6.6%. But recently, because of, let's say, COVID, the government paid a lot of unemployment insurance. They raised it to 6.2% of, instead of 6%, 6.2% of first $7,000 of annual income. Okay, not 6.2% of every income, but 6.2% of first $7,000 of annual income. Now, just to make it easy to remember, let's say 6%, because originally it was 6%. Just recently it increased to 6.2. But let's say 6%. So if it's 6% and there is a SUTA also in that state, so the Futa says just pay me 0.6% and 5.4% goes to SUTA. And that's in general. So 5.4% of first $7,000 of annual income goes to SUTA. 0.6% of first $7,000 of annual income goes to federal, which is IRS, Treasury. Also, there is workers' compensation insurance that employer is 100% responsible to buy that. It's an insurance paid by employer to cover work-related injuries sustained by employees, which is very expensive insurance, very costly for employers. So here we go. This is the same company that employee gets, let's say 1819 at the end, but the payroll tax will be recorded as $240. This $240 comes from Social Security, half of it payable recognition, and Medicare, half of it. So 6.2% of gross and 1.45% of gross for Medicare and Social Security. As you see, this is 195 and 45. It's exactly same as here, 195 and 45. Okay, and this combined is called payroll tax expense, $240. But there is also employee benefit expense to recognize, which that will be, let's say here there is no Futa payable or SUTA payable. Why is that? Because let's say if the employee already passed that $7,000 threshold, so there is no more Futa or SUTA applicable. Futa and SUTA is applicable only to the first $7,000. Insurance payable also is 175. So employee paid half of it here from his paycheck, and employer is paying the other half. Also, employer will pay for workers' compensation insurance for this paycheck period, and also $200 matching the employee's contribution. So those are the benefits in regards to having employees that the company has to pay. So it's employee benefit expense. Futa, no, here, insurance payable, workers' compensation, and retirement. If it is Futa Suta payable, let's say $10 here and $10 there, for example, or $10 here, $5 here, let's say 15, that $10 here and $5 there will be added to 240. So payroll tax expense will be 255. But because it passed already the 7,000 threshold, then it will be zero. And again, at the end of the year, company will provide a Form W-2. It's an annual statement provided to employees stating the amount of earnings and withholdings. Assist employees in preparing their own taxes at the end of the year. Any question? Let me know. Okay, there are some other payments also to employees, terms to describe paid time off, vacations, sick leave, anything that has been accrued for those employees. So they have to recognize liabilities for those also. So pension plan is a general term to describe some form of arrangement for continuing payment to retirees account in, let's say, 401k. There is also a type of payment retirement plan. We call it defined contribution plan. A type of pension plan where the benefits are based on amounts in trust for the benefit of the employee. Employer contributions are usually a fixed percentage of pay. And that is a defined contribution plan, which means in the future, employees, when they get retired, they might get some amount as a form of retirement payments. But you don't know how much it might be. Depends on the performance of this retirement account. If they do good, if they earn good amount of dividend or interest from the investment of those contributions. However, there is another one that is much better, and it's a little bit less available to everyone, but that is mostly available to, let's say, governmental employees. Those are defined benefit plan. That means a type of pension plan where the benefits are a function of years of service, pay, and age. The ultimate employer cost is not known in advance, but the benefit is kind of very good for employees because they easily can kind of estimate what type of benefit they might have. For example, a company may offer annual pension payment equal to 2% per year of service times the final annual salary, or the final average of 3 years of salary, whatever it might be. So 2% of service times final annual salary. So a person who works 30 years and then retires may be eligible for continuing pay at 60% of his or her annual salary. So 30 years times 2%, that's 60, and 60% of final annual salary. Let's say final annual salary was, let's say, $100,000. or final annual salary of last 3 years, let's say, was average $100,000. So before retirement, so that's 100,000 times 2% of service time payments equal to 2% of payments, and that's 30 years of work. So 30 years times 2%, that's 60, and times 100,000, 60% of 100,000, that's $60,000 retirement, annual basis. These plans are very good for employees, but it's unknown for employers that how much they need to come up with at the end of the year, because they don't know exactly when and how they're gonna retire every single employee. But in the defined contribution plan, no, already the employer knows what type of cost he's gonna have at the monthly basis, because they are contributing to that plan also. But whatever the employees will get at the end, that's whatever it is. Employer has no concern about that. They don't care. Whatever it is what it is. Okay.